What's going on, investors? AT&T released their Q3 earnings today, so let's do an analysis. They're now sitting at a market cap of $119 billion, a PE ratio of 6, and a dividend yield of 6.6%. And considering they have a reliable business and high customer retention rate, why does this stock look the way it does? And should we be buying into these lows here? Stick around to find out as we're talking about all that and more on today's episode. Welcome to Everything Investing. I hope you're having a great day. Today we'll be starting with a full analysis into the financials, the top line, bottom line, balance sheet, cash flows. We'll do an in-depth business review, and then finally we'll conclude with an evaluation of this business using our intrinsic value calculator seen on screen, which will identify whether or not AT&T is a value investment or not. And if you enjoy the analysis and the value investing perspective, please leave a like and subscribe as it helps out the channel greatly. And with all that being said, let's jump into the video. And as always, we will start the analysis with the CEO's comments for this quarter. As you can see here, they're investing at record levels to enhance their 5G and fiber connectivity to deliver the best experience available in the market. That is their goal. Their results show their strategy is resonating with customers as they continue to see robust levels of prepaid phone net adds and approach 1 million AT&T fiber net adds for the year. Their go-to-market approach is helping drive healthy subscriber growth with the high-quality customers that they've been looking for, and they now expect to achieve wireless service revenue growth in the upper end of 4.5 to 5% range. They're confident that they can surpass all their financial commitments for the year while still providing customers with absolute value. Okay, how has that translated over the past few years? As you can see, if we look at their revenue, it has progressed quite well, I would say, despite 2019, the challenges that they faced since then, and granted, many businesses have faced since 2019. So it's natural to see a slight slowdown here, but what they're saying is that based on their innovation and such, these numbers should start to trend higher in the coming years. If we look at this from a net income perspective, over the years, it's been relatively flat and hasn't grown all that much, but we'll dive into those numbers on an in-depth level in just a second. I just wanted to point out their return on invested capital has been in and around this 6 to 3% range. So that's typically what you can expect from this investment if you were choosing to invest in a business like AT&T. Let's quickly dive through what their strategy is. And as you can see, their business priorities are to grow the customer relationships, be effective and efficient in everything they do, and then deliberate capital allocation. How are they going to grow their customer relationships? Well, they have a main focus on 5G wireless and fiber, which is growing their business so far, which is also what they're going to be investing in as well. We'll get to that in just a second. In terms of their efficiency, they're on track right now to achieve about $4 billion out of the $6 billion of run rate cost savings that they've targeted. So that's actually pretty solid on their end. This means they're able to save billions of dollars a year, which should benefit this business's bottom line, ultimately improve the fundamentals all around. Also, because of their cost efficiencies and higher RPUs, they're able to offset the inflationary impacts and drive operating leverage. And then finally, again, they're looking to invest in their 5G and fiber businesses. They're also planning on strengthening the balance sheet further. They've already reduced the debt by about $25 billion year to date, although if you've been following my videos, you know all about what they're doing with WBD and offloading debt there. And finally, they're focused on paying out a dividend, and they're actually on track to achieve about $14 billion in free cash flow by the end of the year. And when we compare that to their market cap currently, that's actually about an 11% return on free cash flow. So just on these things alone, if an attractive dividend and nice free cash flow margins, cost savings, etc., all are something that you are looking for in your investments, AT&T might be a great business for you, but we'll get into the numbers in just a second. First, I want to show you what their subscriber gains are looking like so far for 2022. And as you can see, quarter over quarter, they have seen growth over the past year at least. Obviously great to see, but in terms of net adds, their net adds are a little bit down. But the bright side is when it comes to their churn rate, it's actually quite low here. So they're able to retain their customers, exactly what you want to see from a business. You would hate to see their business's churn rate increasing substantially year over year. The fact that it's relatively the same is a great thing to see. Same thing with their AT&T fiber subscribers, with growth year over year. Mobility results pretty strong here with 6% growth in revenues. And then when we get down to their consumer and business wireline results, that's actually relatively flat year over year, despite broadband revenues growing about 6.1%. Now, when we get into our consolidated statement of income here, we can actually take an in-depth look at what they've done over the past year or so. As you can see, we have total operating revenues of $30 billion. This is broken down from $5 billion from equipment and then $24.7 billion from their service revenues. Service revenues are actually down about 6% year over year. However, equipment revenues are up about 4.6% for a total decline year over year of 4.1% in total operating revenues. And with what's going on, that's kind of to be expected in the macro environment. And then when we jump through our operating expenses and cost of revenues, we have $5 billion for equipment, $6 billion for other costs, etc. Add all these costs up and we're left with total operating expenses of $24 billion. And so ultimately that leaves us with $6 billion in operating income, down 3% year over year. Add back in our other income here, which did increase about 50%, definitely a large impact on this bottom line here. We're left with $6.4 billion in net income up 2% year over year. Keep this net income figure, as we will be using this for our calculation towards the end of the video. Before then, we'll jump through our balance sheet here. As you can see, they have about $2.4 billion in cash. They used to have $19 billion in cash last year. We'll talk about what they're doing with the cash. But when we compare that to their debt figure, we have $9 billion current debt, $124 billion long-term debt. That's ultimately about $133 billion in debt in total on the market cap of $119 billion. Ouch. And that is definitely a big reason why this stock is down so much. And they've already taken off about 25 billion debt, as we alluded to earlier in the video. So this used to be a lot worse, and it's getting slightly better, but at this point, way too much debt on the balance sheet, guys, and that's just too much of a risk. While I don't see this business defaulting on their debt or anything like that, I would just prefer to see this balance sheet looking a lot better. And if we look at their total assets, they have $426 billion in assets. So when we compare that to their debt figures, it doesn't look that bad. But when you look at what their assets are actually comprised of, I mean, licenses are about $124 billion. Then we add on our goodwill. We're already at half of the assets are intangibles, right? We have about $130 billion in property, another $40 billion in other assets and operating lease rights. So for those reasons, I am not happy with this balance sheet. It just does not entice me at all to be an investor of this business. Now we'll jump into our consolidated statement of cash flows. We bring down our 9-month figure, net income of $16 billion, add back in our non-cash cost, depreciation, amortization, etc., and we're left with $25 billion in cash from operations. Deduct our $15 billion here for capex, and we're left with about $10 billion in free cash flow. They've also done about $10 billion in acquisitions. But if we're looking strictly at what they're doing with the free cash flow, we can see they've taken on a little bit of debt, repaid about $16 billion of debt. They've also paid about $25 billion on that long-term debt as well, which includes a note to DirecTV. They've also done some vendor financing, purchased some shares, paid out a sizable dividend, and they spent $3.6 billion on other. So as you can see, cash is leaking out of this business while they still have a ton of debt. I really want to see where this business is going over the next year or so, because unless they're able to produce the cash flows and produce more cash into this business, I mean, the balance sheet is going to get worse and worse and worse. And frankly, I really want to see where this goes. All right, so assuming they can produce about $6 billion in net income quarter over quarter for the 4 quarters in the year, we can estimate on an average basis, they can come in with about, let's just call it $25 billion in net income for the year. Now, if we require a 10% return, they are paying a dividend currently, and they can keep that 5-year EPS growth number of 5% for the next 5 years, and then that drops down to, let's call it 3% for the 5 to 10 years after that. On a 10 PE, this stock will be trading at about $344 billion. The market cap is currently at $119 billion, so we'd see a nice significant upside from where we are right now, guys. That's not the problem with AT&T. The problem is not the growth. The problem is not the free cash flow, because we already saw they have about 11% free cash flow yield. The problem is their liquidity on the balance sheet. They know this is an issue. They're trying to bring it down further, but they're just running out of cash to do it. And I just don't know about the future of the business in terms of being able to bring on more subscribers and increase their revenue and fundamentals to the point where that debt is no longer a huge risk for investors. Now, let's actually talk about the best case scenario here. Let's say they can grow at 8% for the next 5 years. That drops down to about 5% for the 5 years after that. On a 12 PE, the stock will be worth $446 billion. Again, looks amazing. Now, in the very worst case scenario, churn rate starts to increase, competitors come into the space, the debt becomes too much of an issue, free cash flow starts to decline, the business isn't able to grow for the next 5 years, and then actually starts to decline by 3% for the 5 to 10 years after that on a 6 PE like they're currently trading at, this stock would technically still be worth about $205 billion, guys. If this isn't a margin of safety, I don't know what is. Or at least that's what I'd like to say to you, but because of the debt that they have on the balance sheet, I can't actually say that I do like this stock overall, and it's definitely the reason why it's down so much. But again, guys, this is a super cheap business right now. They're paying a 6% dividend, 6 price to earnings ratio. I mean, by all means, this is as cheap as it should be for such a big business with a lot of customers. It's just clearly the debt has been weighing on this stock and just bringing it down year over year if we look at this from a 5-year perspective. And now we're down to lows of $14 from highs of $30. So please, when it comes to AT&T, please do your own due diligence, do your own research. Let me know in the comments below what you think. But that's my analysis for this video. If you enjoyed it to this point, leave a like, subscribe, and I'll catch you on the next one.